Good morning, everyone, and welcome to the Daily Hunt for Multibaggers on this Wednesday, May 20th, 2026. We've been sifting through a truly massive amount of market commentary from yesterday, May 19th.
That's right, Ethan. Our AI flagged a significant surge in social media activity, pointing to many different stocks. I'd say the overall market sentiment is a mixed bag today. A lot of speculative optimism, but also some critical risk assessments that need our attention.
Absolutely. Let's dive right in. First up, we're looking at Amazon, AMZN. Our AI analysis shows a consistently positive view, and we're sticking with a buy rating today, which, is consistent with our last call on May 5th. What's catching your eye, Brooke?
Well, Ethan, while the general sentiment is positive, one user even called it a better investment than some other struggling stocks. I'm looking at those KPIs. Revenue growth is a healthy 16.6%, and return on equity is over 24%, which are great. But we've seen news about a recent lawsuit adding risk, and there was some insider selling, though overall net insider activity is still positive. The AI advancements are definitely promising, potentially boosting those margins, but we need to keep an eye on how these risks develop.
True, but let's not forget their huge strides in AI chip development and strategic investments in companies like Anthropic. Those aren't just buzzwords, Brooke. They have the potential to profoundly impact future KPIs, driving more revenue and better profit margins. So for AMZN, our AI-generated insight remains a buy.
Next, we're moving on to International Paper, IP. Our AI suggests a cautious buy, which is an upgrade from its stay away rating back in March. This one has some interesting conflicting signals, Ethan.
It certainly does, Brooke. We're talking about a company that's trading near its 52-week low. That could scream value. Plus, we've seen substantial insider buying, over 300,000 shares purchased, and 0 sales in the last 6 months. That's a huge vote of confidence. They're also making strategic acquisitions to boost their footprint.
And that's where my KPI-driven skepticism comes in, Ethan. While insider buying is a strong signal, this company is currently unprofitable with a negative net profit margin and EPS. It also has a very high debt-to-equity ratio at nearly 66. Yes, it has a 6.3% dividend yield, but how sustainable is that with current losses? For me, the current financials warrant caution, even with insider optimism.
Agreed, the profitability is a concern, but the insiders' actions often precede a turnaround. They're seeing something the market hasn't fully appreciated yet. Their strategic growth moves, especially at this price point, could make for a compelling recovery story. So for International Paper, we're classifying it as a cautious buy. All right, let's talk about State Street Corporation, STT. This is a new one for us on the show.
And for me, a clear stay away for now. Ethan, the stock is trading very close to its 52-week high after a strong rally. While it shows good profitability with a 21% net profit margin, the revenue growth is actually slightly negative. That tells me the recent rally might have already priced in a lot of the good news. And without top-line expansion, sustaining that growth will be tough. Plus, with a beta of 1.46, it's more volatile than the market. I hear you on the revenue growth, Brooke, but we're seeing strong insider purchases here too, over 280,000 shares, which indicates internal confidence. And let's not overlook their innovation. They're launching tokenized stablecoin products. That's a forward-looking move that could absolutely kickstart future revenue growth. A strong multi-year rally isn't just luck. It's often based on solid underlying performance. It's promising, but I just don't see the numbers lining up for immediate upside. Buying at a peak with negative revenue growth, even with insider buys, adds significant short-term risk. For STT, our speculative analysis is to stay away for now until that revenue picture improves. Moving on to SAP SE, SAP. This is another fresh face on our list today, and the sentiment is looking pretty bullish. It is, Ethan, but the KPIs give me pause. While there's a lot of user excitement about SAP being an AI SaaS race winner and a potential rebound from its 52-week low, I'm noting that high debt-to-equity ratio of over 17. That's a lot of leverage. That's a fair point, Brooke, but let's remember this is a rebound story. The stock's trading well below its 52-week high, and the AI-driven innovation with their autonomous enterprise vision and AI agent integration could be transformative. Users are saying SAP is uniquely positioned to take advantage of AI given its deep roots in enterprise systems. Plus, a target of 10 billion euros in free cash flow by 2026 and a substantial share buyback program show management's confidence and commitment to shareholder value. The 10 billion euro free cash flow target is compelling and the 6% revenue growth is steady, but the high debt means they need to deliver on those targets. It's a high reward play if their AI strategy pays off, but the financial structure makes it inherently riskier. True, but the market seems to be reevaluating, and the positive technical outlook reinforces that. For SAP, our AI-generated insight is a buy. Now, let's talk about the big one, NVIDIA, NVDA. We've had a lot of discussion on this. Our last rating was a buy yesterday, and we're sticking with that today. Oh boy, NVIDIA. My models show immense profitability with 55% net profit margin and 73% revenue growth. Those numbers are truly exceptional. But Ethan, the PE ratio is still high at 45, and the market cap is $5.34 trillion. We also saw a significant amount of user discussion anticipating short-term drops right after earnings, even when they beat expectations. It's a highly volatile stock with a beta of 2.244, which means those price swings are going to be wild. And let's not ignore that debt to equity at over 7. I understand the caution, Brooke, especially around earnings, but the prevailing sentiment, despite the short-term earnings volatility, is that NVIDIA always bounces back stronger. The PEG ratio is an impressive 0.71, suggesting it's actually undervalued relative to its growth. And we can't ignore the massive insider buying, over 58 million net shares purchased in the last 6 months. This is the godfather of AI we're talking about, poised for sales outperformance. The long-term picture here is overwhelmingly bullish. Long-term perhaps, but for any short-term speculative plays, particularly around earnings, the historical data suggests extreme caution. For the fundamentals and long-term potential, our AI-generated insight for NVIDIA is a buy. All right, let's turn to Microsoft, MSFT. We had them as a buy yesterday, but today our analysis suggests a significant shift. And for good reason, Ethan. Our AI is now flagging Microsoft as a stay away. This is a downgrade. The analysis points to Bill Gates' charitable trust selling its entire remaining stake. More critically, a former Microsoft VP stated they missed the AI wave like the internet and mobile, citing Bing's failure to gain search market share and an abysmal less than 3% active usage for Copilot. That's a huge red flag on their future growth drivers. Wow, those are pretty damning claims. I mean, Microsoft has been pushed as a best AI play by other news sources, and their revenue growth is still strong at 18.3%. Surely some of that positive sentiment must counteract those criticisms.
While there are indeed conflicting news reports touting it as a best AI play, the specific, pointed criticisms from a former insider, backed by low Copilot usage numbers, directly challenge the future growth narrative, and the net insider selling we've seen only amplifies that concern. The PEG ratio of 1.31 also indicates the stock is already quite optimistic relative to its growth. Those insider sales and low AI adoption numbers have a strong potential to negatively impact those seemingly strong historical KPIs down the line. For MSFT, our speculative analysis points to stay away. Finally, we're looking at Everspin Technologies, MRAM. This one came up with a lot of community discussion around its future of memory potential. And our AI's final verdict is a strong stay away. Ethan, this is a textbook example of hype versus reality. While there's a bullish case floating around about edge AI and space chips, the KPIs are screaming red. We're talking about an astronomical PE ratio of over 3,100. The company is currently operating at a net loss with a negative net profit margin, at a high debt-to-equity ratio of 4.8, and it looks incredibly risky. But wait, Brooke, the original post highlighted over 600 MRAM patents, a $40 million defense contract, and the transformative potential in future tech. Isn't that enough to warrant a closer look for growth potential? It sounds good on paper, but the user comments challenge that IP moat, pointing out that other major players have thousands of MRAM patents. There are also strong accusations of pump-and-dump behavior due to rampant insider selling, despite some net purchases. Jim Cramer even flagged it for almost no revenue. The current stock price appears to have already factored in a highly speculative future, without the underlying financial performance to back it up. For MRAM, our speculative analysis says stay away. All right, Brooke, for our listeners looking for where to dig in deeper, here's our compiled list from today's AI-generated insights. Investigate as buy, Amazon.com, SAP ADS, NVIDIA Corporation. Investigate as cautious buy, International Paper Company. Investigate a speculative gamble, Everspin Technologies, Inc. And that wraps up our daily hunt. Before we go, a quick but important disclaimer. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Absolutely. Thanks for joining us today on the Daily Hunt for Multibaggers. We'll be back tomorrow with more AI-generated insights into the market. Until then, happy hunting.